Welcome to Talk Tickers. Usually we are here to break down the quarter, right, to dissect the guidance and tell you why that 4% pre-market pop is, well, essentially noise.
Yeah, we usually live in the world of EPS and EBITDA.
Exactly. We live in the weeds of the earnings calls. But today, we are intentionally ignoring the stock ticker. We aren't looking at a quarterly earnings miss from some tech giant, and we certainly aren't talking about the latest AI hype cycle. We are looking at the plumbing.
And the thing about plumbing is, nobody really cares about it until the pipes burst. But when the plumbing changes, when you literally swap out the pipes, the structural integrity of the entire house changes.
Yeah, that is exactly what we're looking at today. We are talking about the money in your pocket, or more accurately, the money that won't be in your pocket much longer.
Right.
We are talking about the fundamental architecture of the global financial system. Today's deep dive is into the digital ledger war, central bank digital currencies versus stablecoins.
And I want to be super clear right off the top here. This is not some far-off sci-fi future. This isn't a 10 years from now conversation where we speculate about flying cars.
Not at all.
Central banks representing over 90% of global GDP are exploring this right now, today. This isn't just some IT upgrade for the Federal Reserve or the European Central Bank. This is a massive shift in the very definition of legal tender.
And for investors, for anyone actually paying attention to the macro landscape, the core conflict here isn't just about whether your transaction clears in 5 seconds or 5 milliseconds.
Right, because that is just the surface level. That is the marketing pitch they give you.
Exactly. The real story is a battle for the soul of the financial system. It is a direct face-off between public money, which is the CBDC, and private money, which is the stablecoin, and the casualties stuck in the middle of all this.
Privacy. Or, if you play the market right, privacy might actually be the ultimate premium.
So today we are basically stripping down the mechanics. We have a massive stack of research we've been going through, economic modeling, sociological studies on adoption structural white papers. We are going to explain why a CBDC is not just quote unquote Bitcoin, but owned by the Fed.
It's very different.
We're going to look at the architecture, who actually holds the keys to the ledger. We are going to go really deep on what's called the privacy paradox, like how do you stop money laundering without creating a complete surveillance state?
Which is the trillion-dollar question.
It really is. And finally, we're going to look at the market implications. Will a digital dollar completely kill the crypto market, or ironically, will it be the fuel that sends it into overdrive?
It is a totally complex web, but we've got the material to untangle it for you.
So let's just start with the basics, the asset class distinction, because I think a lot of listeners hear digital currency and they think, well, I already use Apple Pay, I already use online banking.
My paycheck is a direct deposit.
Right. I tap my watch to buy a coffee. My money is already digital. So what is the actual difference here?
That is the number one question. It is the absolute hurdle everyone has to get over to even begin to understand this topic. And to answer it, we have to stop looking at the user interface, the Slick app on your phone, and we have to look at the balance sheet.
Okay.
It all comes down to liability. That is the magic word in finance.
Break that down for us. When I log in and see $1,000 in my Chase or Bank of America app, whose liability is that?
That digital number on your screen is a liability of the commercial bank. You are essentially lending your money to the bank.
Which people forget.
All the time. You have become an unsecured creditor to Chase. They take your money, they lend it out for mortgages, they buy treasuries, they invest in corporate debt. That money isn't sitting in a vault with your name etched onto a gold bar. It is just a promise. They promise to give it back to you when you ask for it.
Which works 99.9% of the time?
Right. Until it doesn't. Until you have a Silicon Valley Bank situation. If that bank goes bust, you are relying on deposit insurance, FDIC. But fundamentally, commercial bank money involves credit risk. You are completely trusting the bank's solvency.
Okay, so that is the status quo. Commercial bank money is a private promise backstopped by the government. Now enter the CBDC.
A CBDC is a direct liability of the central bank itself. It is the digital equivalent of handing someone a physical dollar bill.
Okay.
When you hold physical cash, you hold a claim on the Federal Reserve. A CBDC is simply that exact same claim, but in a digital token or an account. It is theoretically risk-free in terms of credit risk, assuming the government itself doesn't just collapse.
So if I hold a Fed coin or a digital dollar, I don't care if JP Morgan goes bust. My money isn't with JP Morgan. It is sitting with the Fed.
Exactly, and that distinction is massive. It creates a risk-free digital asset that is also legally defined as legal tender.
And legal tender status is key here too, right? Because I can't just pay my taxes in Amazon gift cards.
Crucial distinction, yeah. Legal tender means it absolutely must be accepted for payment of debts and taxes. Private payment rails, crypto credit cards, a merchant can completely refuse those.
Right, a landlord can say, I don't take Bitcoin.
Or a deli can say cash only and refuse your Amex. But legal tender is the base layer of the economy. It is the final settlement instrument. A CBDC is the government explicitly saying this is money.
Now, before we move on to stablecoins, we do need to distinguish between the two types of CBDC we keep seeing in the research, retail versus wholesale, because the financial headlines confuse them constantly.
They really do. So wholesale CBDC is for the big boys, financial institutions, interbank settlement. It is basically an efficiency play for the back office of the financial system to make clearing large trades faster and cheaper.
It's B2B, essentially.
Exactly. It replaces the old clunky systems like SWIFT or FedWire with something faster. It is important, sure, but it's boring plumbing. It doesn't really change your daily life. We aren't focusing on that today. We're focusing entirely on retail CBDC.
Retail CBDC.
Yes. This is the version available to you, me, the coffee shop, the corporation down the street. This is the actual disruption to the public.
Okay, so that is the public side, digital cash issued by the state. Now let's look at the challenger in this war, the stablecoin. How does this differ from the CBDC we just defined?
A stablecoin is fundamentally private money. It is a token usually running on a blockchain like Ethereum or Solana that is pegged to a currency, usually the US dollar. So think USDC or Tether. But it is a liability of a private issuer, a private company.
So if I hold a USDC, I do not have a claim on the Fed. I have a claim on Circle, the company issuing that token.
Precisely. And the value of that token depends entirely on two things. First, the collateral backing it, and second, your trust in the issuer. Does that company actually have the dollars, the treasuries, the commercial paper sitting in a vault somewhere to back up every single token they minted? It carries direct counterparty risk.
We have definitely seen this movie before.
Oh, we have. If the issuer goes insolvent, or if the assets backing the coin drop in value, the peg breaks. The token that was supposedly worth $1 is suddenly trading at 90 cents, then 80 cents. We saw this massive panic with Terra Luna.
Though that was an algorithmic failure, right?
Yeah, algorithmic, not asset-backed, but the principle of the loss of confidence is exactly the same. Even with asset-backed stablecoins, there have been moments over the weekends where they wobbled and people panicked.
It is the difference between a casino chip and a dollar bill. The chip is worth $1 as long as the casino has the cash in the cage to cash you out when you leave.
That is a fantastic analogy. The stablecoin is exactly the casino chip. It works incredibly well inside the casino or inside the crypto ecosystem. It moves fast. It is programmable. It settles instantly on the blockchain, but its value is completely derivative. The CBDC, on the other hand, actually is the dollar.
So why are central banks so terrified right now? If they have the ultimate risk-free asset, why are they rushing to build this digital version now? They've had decades to digitize cash. Why this sudden urgency?
Monetary sovereignty. That is the fancy academic term you will see in all the white papers. The simple translation is they are terrified of losing control. You have private money stablecoins and crypto actively encroaching on the core payment system.
It is a competition for the medium of exchange itself.
Exactly. Because think about it. If everyone starts using a private token for daily commerce, if we all start paying for coffee in USDC, or if businesses start settling major invoices in Tethered, the central bank completely loses its ability to control monetary policy.
How so?
They lose their grip on the interest rate levers. If the broader economy runs on a private rail, the Fed's interest rate hikes or cuts might not transmit to the real economy effectively at all.
And it wasn't just Bitcoin that scared them. It was big tech.
Oh, absolutely. That was the real catalyst. Do you remember Diem, the project formerly known as Libra?
Meta's project, Facebook's attempt at money.
That was the ultimate wake-up call. The visceral panic moment for central bankers globally. They looked at a closed-loop payment system run by a tech giant with billions of captive users, Facebook, WhatsApp, Instagram, and realized something terrifying.
That they could flip a switch and dominate.
Exactly. They realized if Meta launches this, they become the world's biggest central bank overnight.
Imagine if Amazon or Apple did it. You get a 5% discount for using Amazon Coin. Suddenly, nobody's using regular dollars anymore.
That is the nightmare scenario for any sovereign government. A walled garden economy where a private corporation actively controls the money supply. That specific threat is what accelerated CBDC projects globally. It wasn't just about efficiency or financial inclusion, though of course those are the nice stated goals in the press releases. It was about pure survival. They realized they needed a public option for digital currency before a private option took over the world.
So we have the players perfectly defined. Public money versus private money. Now we need to look at the battlefield. This is what the research calls the architecture of control. Because how you actually build this system determines who sees your data.
And this is where we get into the real nuts and bolts. The choice between what they call one-tier and two-tier models. And this choice basically decides whether we are building a massive surveillance state or a modern functional banking system.
Walk us through the one-tier model first. This is the direct model, right?
Right. In a one-tier model, the central bank does literally everything. They issue the currency, they onboard the customer they build, and handle the wallet app on your phone. And crucially, they record every single individual transaction on their ledger.
So the Fed would essentially be my bank teller.
The Fed would be your bank, your credit card processor, and your auditor, all rolled into one giant institution.
That sounds incredibly inefficient.
It is inefficient and it is highly dangerous. The risk here is pretty obvious. It creates a massive, unprecedented concentration of data. It turns the central bank into a commercial bank, which they are historically not good at. They do not know how to do retail customer service.
Yeah, the Fed doesn't want to handle my password reset.
Exactly. And the privacy implications are staggering.
It is the ultimate Big Brother model.
If that one central database gets hacked, the entire nation's granular financial data is exposed. And politically, it is a non-starter in almost most Western democracies. It creates a single point of failure and a single point of absolute surveillance.
Which naturally brings us to the two-tier model. This seems to be the preferred route for the US, Europe, and most democratic nations based on the papers we reviewed.
Yes, the hybrid model. In this setup, the central bank issues the currency. They handle the wholesale issuance layer. But the intermediaries, the commercial banks, the payment service providers, they handle the entire retail side.
So they do the grunt work.
Right. They do the KYC, the Know Your Client checks. They provide the consumer wallets. They handle the customer service lines.
So it looks a lot like what we already have right now.
On the surface, yes, it feels very familiar. It distributes the data risk. The central bank doesn't see that you specifically bought a bagel at 8 a.m. The intermediary sees that. It creates data silos similar to the current banking system. Chase sees what you do with your Chase wallet. Wells Fargo sees what you do with your Wells Fargo wallet.
But the underlying asset you're moving around is fundamentally different.
Right, exactly. You are holding a central bank liability, that risk-free digital cash we talked about, but it is managed through a private bank interface. It is an attempt to basically get the best of both worlds. The safety and finality of public money combined with the innovation and privacy buffers of the private sector.
Now, under the hood of this two-tier system, there is another major debate taking place: the database itself. Are we using a centralized database or distributed ledger technology, DLT? Because I think everyone hears digital currency and just immediately assumes blockchain.
And that is a huge, pervasive misconception. A CBDC absolutely does not need a blockchain. A centralized database is incredibly efficient. It is wildly fast. It is exactly what Visa and MasterCard use today. Visa can process 65,000 transactions per second without breaking a sweat. Blockchains, by their very nature, are generally much slower.
So why would any central bank even consider DLT for a CBDC then?
Two reasons, really: resilience and programmability. A centralized database is a giant honeypot. If you hack the central server or if the server goes down, you own or break the entire network.
And DLT solves that.
DLT means the ledger is jointly managed by different independent entities. It is distributed across multiple locations. So if one node goes down, say there's a massive power outage or a localized cyber attack in New York, the nodes in Chicago and London just keep the system running seamlessly. It is fundamentally a national security play.
But just to be clear, it is not decentralized like Bitcoin, right?
No.
Not at all. And that is a critical distinction for you to keep in mind. In a CBDC context, any DLT is what they call permissioned. The central bank still completely calls the shots. They decide exactly who gets to be a validator node. It is an exclusive club. It is not Bitcoin where anyone with a computer can just join the network and start validating transactions.
Okay, so we have the definitions, we have the architecture. Now we get to the part that I think listeners care about the absolute most. The privacy paradox.
This is the third rail of CBDCs. It is the core issue that will ultimately decide if these things actually get adopted by the public or if they fail completely.
Set the stage for the paradox. What makes it a paradox?
It is simple, really. Physical cash is entirely anonymous. If I hand you a $20 bill, there is zero record of that exchange. Digital payments, however, are inherently traceable. Central banks have a dual mandate that is essentially completely contradictory.
Which is?
Mandate 1, protect user privacy. Mandate 2, enforce anti-money laundering and countering the financing of terrorism rules, AML and CFT. Right, so they need to see absolutely everything to catch the bad guys, but they promise not to look at the good guys.
Exactly. It is the classic black box problem. If the central bank or the broader government has the technical capability to see every transaction to catch a single terrorist, they also have the capability to profile every single normal citizen.
And this isn't just an abstract philosophical fear. We can easily see how this data could be weaponized.
Oh, absolutely. The research points this out clearly. They can assess creditworthiness purely based on where you shop. Oh, you spend a lot at the local liquor store. Maybe you are a high-risk borrower. Let's raise your mortgage rate. Or even worse, political profiling.
Right. You're donated to the wrong opposition party. Maybe that automatically triggers a tax audit.
We have seen this fear play out in real-time debates. The idea that if the government doesn't like what you are doing, they can just digitally turn off your wallet.
That is the extreme fear, yes. But even without the literal off switch, the everyday surveillance aspect is huge. And the interesting thing is when you look at the market research specifically, there are some really fascinating survey experiments by Choi and others that we reviewed for this. People explicitly say they don't care about privacy until they suddenly really do.
Right. The classic privacy paradox in consumer behavior. I am perfectly willing to trade my personal data for a free flashlight app on my phone, but I absolutely do not want my neighbor knowing how much credit card debt I have.
The studies consistently show that people are generally quite willing to use CBDCs for the convenience, but that willingness jumps significantly by up to 60% in some specific data sets when strong cryptographic privacy protections are legally guaranteed. And it is highly context dependent.
What do you mean context dependent?
So if you were just buying a coffee or a train ticket, you generally don't care if that transaction is recorded somewhere. That is a non-sensitive purchase. But if you are buying what the researchers call privacy-sensitive goods, the examples they used in the studies are things like psychiatric medication or making a sensitive political contribution. Suddenly privacy becomes the primary driver of your behavior.
People will just stick to physical cash if the CBDC doesn't offer total anonymity for those specific sensitive transactions.
Correct. And it correlates almost one-to-one with a person's baseline trust in government. If you highly trust the government, you are totally fine with a standard CBDC. If you have low trust in the government or low trust in big tech, you will fiercely cling to cash or privacy-centric crypto unless a CBDC is explicitly designed to be completely blind.
So how do we actually solve this? How do we build a modern digital dollar that isn't just a massive spy tool? The research outlines some really interesting structural solutions.
Yeah, there are a few clever operational designs. One of the main ones is the separate repository model.
Unpack that one for us.
Imagine two completely different physical buildings. Building A securely holds all your identity data, your name, your social security number, your home address. Building B holds only the transaction data, meaning wallet ID X sent $50 to wallet ID Y.
Okay, I follow.
Building A knows exactly who you are, but has zero idea what you bought. Building B knows exactly what was bought and when, but has zero idea who actually bought it. And legally and technically, they absolutely cannot talk to each other without a specific, targeted judicial warrant.
So it structurally breaks the link. It creates a hard data firewall.
Exactly. It prevents automated algorithmic profiling of the whole population. It is a very solid structural fix. Another major solution proposed is anonymity vouchers.
I love this concept. It honestly sounds like a ration card for privacy.
It is. Ideally, it functions as a digital privacy allowance. Every single citizen gets a set limit. Let's just call it $1,000 a month. For any transaction under that limit, or until you hit that monthly cap, your spending is completely mathematically anonymous. It functions exactly like digital cash. Zero tracking.
But what if I try to buy a car?
Right. Once you go over that limit, or if you try to transfer a huge lump sum, the AML rules instantly kick in and the transaction becomes fully traceable to the authorities.
It perfectly balances the everyday need for small dollar privacy with the state's need to stop massive systemic money laundering.
Precisely. It actively mimics how we naturally use cash today. You don't try to buy a house with a briefcase full of cash without raising massive eyebrows, but you buy lunch with cash all the time and nobody cares. It basically codifies that existing social behavior directly into the software.
But these are ultimately just policy solutions, right? Policies can and do change. A new administration comes into power, they decide they want more surveillance, they just change the rules. We need to talk about the technical toolkit, the actual math, because math doesn't care about politics.
This is where we get into PTTs, privacy-enhancing technologies. Moving the system beyond trust us, we promised you mathematically cannot verify me.
The big one here, the one everyone is talking about, is zero knowledge proofs, or ZKPs. We hear this specific acronym thrown around in crypto circles constantly. What does it actually mean in a practical CBDC context?
The core concept of a ZKP is proving a statement is objectively true without revealing any of the underlying data that makes it true.
Give me a real-world analogy so I can picture this.
Okay, imagine you are trying to get into a bar. The bouncer needs to know if you are over 21. Currently, what do? You hand him your driver's license. He sees your full name, your home address, your exact date of birth, maybe even your height and your organ donor status. He sees absolutely everything just to verify one single tiny thing. Is this specific number greater than 21?
Right. It is massive data overkill. It is a data leak every single time I just want to buy a beer.
A zero-knowledge proof is like a magical little machine where you scan your ID inside it, and the machine just flashes the solid green light to the bouncer. The bouncer knows the machine cryptographically verified you are over 21, but he never saw your name, your address, or your actual age. He just knows the specific condition was met.
So apply that directly to a CBDC transaction.
You can mathematically prove you have enough money in your account for a transaction without ever revealing your actual account balance to the merchant. You can prove your money didn't originate from an internationally blacklisted address without revealing your entire lifetime transaction history to the auditor. It beautifully allows for strict regulatory compliance, verifying the validity of the funds without enabling mass state surveillance.
That is incredibly powerful. It fundamentally solves the paradox.
It really was. It is often referred to as self-sovereign identity. But it's not the only tool in the shed. We also have blind signatures. This concept goes way back to the early days of digital cash, like the David Chaum era.
Right, the absolute grandfather of crypto privacy.
Yes. Blind signatures are basically like putting your physical voting ballot into a sealed carbon paper envelope. The bank physically signs the outside of the envelope to say, yes, this is a valid token, but they can't ever see what is inside it. In banking terms, the central bank signs a digital banknote. They absolutely know they issued a $20 token to your specific account.
Okay.
But when you actually spend that token later, the bank cannot mathematically link that specific spent token back to your original withdrawal. They know it is valid state money, but they simply don't know it was you who spent it at that specific store.
It completely breaks the chronological link between the withdrawal event and the spending event.
Exactly. And then you have other methods like ring signatures, which involves hiding a single sender's input among a large group of decoy inputs, which is very similar to how the privacy coin Monero functions. And stealth addresses, which involves generating a brand new one-time address for every single individual transaction, so auditors can't just look up a wallet ID and see his entire history mapped out.
So if all this amazing technology already exists, why aren't central banks just rushing to implement it? Why isn't this the default standard for every CBDC pilot program?
The compliance hurdle. These technologies, especially ZKPs and ring signatures, they are highly computationally heavy. They demand a lot of processing power, which makes the entire settlement system slower. But more importantly, regulators are absolutely terrified of accidentally creating a perfect, unbreakable tool for global money laundering.
Right, if the privacy is just too good.
If the privacy is too perfect, how do you ever catch the real terrorists? How do you track and recover massive ransomware payments? The engineering challenge right now is designing a ZKP that perfectly proves compliance without revealing identity, which is technically very difficult to balance. Regulators secretly want a backdoor, but they want to politely call it a compliance gate.
So we have the tech tools, we have the architectural models. Now let's talk about the money, the market dynamics, because this is where the specific investor context really matters. There is a deeply fascinating economic model from the research regarding crowding out versus crowding in.
This is hands down the most counterintuitive part of all the research we looked at. Everyone naturally assumes a government CBDC will just instantly kill private stablecoins. But the economic modeling strongly suggests it depends entirely on two specific variables: privacy and interest rates.
Let's take scenario A first. The curse scenario.
Scenario A is the absolute nightmare for companies like Circle or Tether. Imagine the central bank releases a retail CBDC. It is designed with extremely high privacy, maybe using those anonymity vouchers we discussed. And crucially, it pays a high interest rate directly to the user.
So as an everyday user, I have a risk-free asset issued directly by the Fed that pays me a solid yield and completely keeps my data private from advertisers and the government.
Why on earth would you ever hold a risky private stablecoin that pays you zero interest? You just wouldn't. The CBDC aggressively crowds out the private market. It entirely destroys the core value proposition of stablecoins. It sucks all the liquidity straight out of the private crypto sector.
But then there's scenario B, the blessing. And this is the one that really caught me off guard when reading the models.
Right, imagine the exact opposite. The central bank issues a CBDC that has extremely low privacy, meaning full state surveillance at cent. Everyone knows what you're buying at all times. And it pays extremely low or zero interest.
So it is essentially just a highly surveilled digital dollar with no yield.
Exactly. Everyday consumers won't really want to use it for retail transactions because of the massive privacy concerns. But, and here's the huge twist in the model, massive investors in crypto banks will aggressively use it as collateral.
Collateral. How does that work in this context?
Think about the biggest systemic problem in DeFi right now, decentralized finance, collateral quality. If you back a new stablecoin with Bitcoin, it is highly volatile. If you back it with US Treasuries, you need a trusted real-world custodian. But if you back it directly with a CBDC, you suddenly have a purely digital, natively programmable, risk-free bearer asset.
So the CBDC essentially becomes the ultimate reserve asset for the crypto world.
Correct. The CBDC becomes the base layer. The deep plumbing reserves and private stablecoins become the fast transactional layer sitting entirely on top of it.
The private sector basically builds the privacy layer that the government refused to build.
Exactly. People will flock to use the private stablecoins because they offer far better privacy or better utility in specific DeFi apps, knowing comfortably that those stablecoins are fully backed one-to-one by the risk-free CBDC locked in a smart contract vault.
So paradoxically, if the central bank makes a quote-unquote bad CBDC with low privacy, it might actually fuel an unprecedented boom in private stablecoins.
That is the crowding in effect. It essentially heavily subsidizes the stablecoin market by providing them with a perfect, flawless form of collateral. It is the crucial difference between the CBDC acting as the competitor versus acting as the foundation.
And the interest rate is the main lever they have to pull to control this dynamic.
It is a massive macro policy tool. If the yield rate is too high on a CBDC, you rapidly drain trillions in deposits from commercial banks, which is a huge disintermediation risk that could collapse local lending. If the rate is too low, nobody uses it at all, or it just becomes silent back-end plumbing for crypto bros. The central bank has to expertly thread a very tiny needle here.
Which is exactly why many of the experts in these papers think the crowding in scenario is the most statistically likely outcome. We will probably end up with a highly tiered system. The CBDC sitting at the bottom, private stablecoins sitting in the middle, managing the flow, and thousands of DeFi apps sitting on top.
This perfectly brings us to the one question. We always try to wrap up our deep dives with one single vital question that cuts through all the white noise. If you are an investor, or frankly, just a concerned citizen looking at a proposed CBDC rollout in your country, what is the one single question you must ask?
The question is simply this. Does the architecture of this specific digital currency support programmability directly at the issuer level?
Programmability. Why does that specific feature matter so much?
Because if the issuer, meaning the central bank or the state, can directly program the currency itself, they can fundamentally change the rules of the money while it is sitting in your wallet.
Give me a concrete example of that.
Expiration dates. We have already seen this actively tested in pilot programs over in China. The government says, spend this digital stimulus check by Friday night, or the money literally mathematically disappears from your wallet.
That absolutely forces the velocity of money.
Oh, it is an economic stimulus dream for a central planner, but it is a complete nightmare for a saver. It instantly turns money from a reliable store of value into a burning hot potato.
Or they could use it for restricting exactly what you buy.
Exactly. The code could say you cannot buy from this specific unapproved vendor. Or you cannot buy more than X amount of carbon-heavy goods this month, like gasoline or red meat.
If they can do that, you aren't really holding an asset anymore, are you?
No, absolutely not. You are holding a conditional government voucher that can be turned off or geographically restricted at will. Programmability at the issuer level fundamentally turns money from a neutral store of value into a highly targeted tool of social and policy control. That is the absolute red line for adoption.
That is a deeply chilling thought to end on, but a very necessary one to understand. So let's quickly wrap this up with our synthesized key takeaways from all the sources.
Takeaway 1, liability absolutely matters. You have to know who actually owes you the money. A CBDC is a risk-free direct claim on the state. A stablecoin is a private corporate liability with inherent counterparty risk. Do not ever confuse the two when assessing your portfolio.
Takeaway 2, privacy is the ultimate product here. The broad public success of any CBDC will completely hinge on whether they adopt the separate repository model or robust ZKP tech. If they refuse to do that, mass adoption will deeply struggle against the anonymity of physical cash and privacy-centric crypto alternatives.
And takeaway 3, you need to watch the macro shift. Keep a very close eye on the proposed interest rates and privacy settings of any upcoming CBDC legislation. High rates plus high privacy equals stablecoin death. Low rates plus low privacy equals a massive stablecoin boom as a layer 2 solution.
The ultimate truth here is that the technology already exists to have both total privacy and strict compliance. We do not have to forcefully choose between money laundering chaos on one side and a dystopian surveillance state on the other. The math already completely works.
Right. The question isn't whether it can be built securely. The real question is whether the political will actually exist to willingly build it that way.
And that is a developing question we will absolutely keep tracking right here. This has been Talk Tickers. Do your own diligence. We will see you on the next deep dive.